Dear friends, welcome to the Fixed Income Monthly Outlook for October 2018. Last 1 month have been quite eventful in fixed income markets. And on Friday, RBI came out with its monetary policy outlook. Let us first understand what are the macro events which has happened over last 1 month in run up to this policy. US, it continues on its momentum for the strong growth and which has allowed Fed to do a calibrated tightening. This has resulted in rise in USD yields at one hand and large amount of outflows from emerging markets which continued over this period. At the same time, some of the emerging market economies, they continue their hiking stance on the rate front. So on one hand, US continues its growth momentum, and on the other hand, most of the other developed markets and emerging market economies, they have started losing growth momentum along with depreciation biasness for their currencies. In India, although inflation numbers have surprised policymakers at large, the latest growth numbers were better than what anticipated. However, locally, on account of the rise in crude prices and depreciating currency, it was a consensus that RBI will take a call in cognizant with the other emerging market central bankers, and they will also hike rate by 25 basis points in this policy. So against the market consensus, RBI chose to do a status quo on this policy and they hold on their policy rate. Along with that, they changed their stance from neutral to calibrated tightening. And the reason cited was that the inflation has been consistently below the RBI projections up till now. Not only this, they maintain their growth path or growth projections, and they have reduced their inflation projection for next 6 to 9 months by about 30 to 40 basis points across. Calibrated tightening means RBI continues to be on rate hike path, but it may not be as steep, which has been factored by the market already. But the bigger news here is that RBI coming out and clearly stating to the markets that they are focusing on inflation, which is what the legal mandate given to the MPC. It also means that interest rates will unlikely to be used as a tool to protect currency depreciation by and large. So another interesting point that RBI made in its post-policy press conference was that they are concerned over the growth of NBFC lending book and the way their ALMs are being managed. It may be noted that over last 3 years, NBFC has been the major source of credit provider to the country at large. So we clearly see that there is a downside risk to the growth projection of RBI at 7.4% of FY19 on account of tighter monetary conditions, higher commodity prices led by the crude, and uncertainty on political front. On NBFCs and housing finance companies, our take is that we don't cite any significant solvency risk on them. But at the same time, they need to manage their ALM better given the current scenarios have changed completely. This should lead in compression over their NIMs and higher cost of funds, and also much lower credit growth incrementally. We understand investors have a lot of queries regarding exposure to NBFCs and HFCs after the event of ILFS. In our understanding, NBFCs and HFCs at large, they don't face any solvency risk. However, in wake of new market development, their cost of funds will go up, their NIMs will come off, which will lead to lower credit growth from their side. It also exposes us to the mark-to-market risk in wake of new spreads which will settle. Thus, one need to be cautious and increase exposure to these entities only when markets stabilize. We are also doing the same at our end. Given higher uncertainty on global macro front and tighter monetary and credit conditions locally, it is more prudent to stick to the shorter end of the curve. Thus, for new investors, we advise them to come to the liquid and money market funds which run minimal duration and lower credit risks. For the existing investors, we would advise them to stay put on their investments as these environment of higher vols have led to higher YTMs. Thus, the incremental accrual to them would be quite lucrative over the long term. It may be noted that in our credit funds, the YTMs are already in the range of 11.5 to 11.75, which is about 300 basis point above AAA corporate curve and about 400 basis point over the fixed deposit rates. Thus, for the long-term investors, these funds make quite a reasonable case for investments. Thank you. Happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.